Loving the Smart Property Investment Show? Then you're going to love tuning in every Monday to the Scouting Australia podcast, hosted by Sam Gordon, Smart Property Investment Show's most downloaded guest.
That always just triggers in my mind. Like I'm always wanting to look after people because of what happened to me there.
What are you waiting for? Listen to the pros at the Scouting Australia podcast, now on all your streaming platforms, and get educated.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hello, everyone. Welcome back to a brand new episode of the Smart Property Investment Show. I'm Grace Ormsby, and I cannot believe how quickly this year has flown by. For those of you that are listening on the day of the release, we are heading into the Easter weekend this weekend. April already. We've already had a quarter of 2023. Absolutely absurd. And it's been a while. I realized a couple of weeks ago back now, we haven't had our friend Dr. Diaswati Mardiasmo on the show for a while, the PRD chief economist. Asti, welcome back. Thank you so much for taking the time.
Hello. It's so good to be back. I can't believe it's 2023 and it's April.
It's ridiculous. It's absurd. The fact that, we're practically halfway through the month by this point, given that we've got, a long weekend coming. We've got the Anzac Day public holiday later in the month as well.
April and May just flies through because of the amount of long weekends that we are getting. And then suddenly we'll be talking about the federal budget, which was coming up at the end of May. And then we're talking about tax time and end of financial year in June. It's
ridiculous.
It's like a speeding bullet.
But we love it. I mean, it's property. There's always so much going on. And this year has absolutely been no exception. We've obviously come off the back of a boom time period in 2021. We saw much of the same conditions for summer of 2022 as well. We're going into a pretty different environment in 2023. And this week's Reserve Bank of Australia rate decision is pretty much testament to that. I'm so glad today's the day we've actually got you on the show, Asti, because we have just had Dr. Lowe hand down the April cash rate call, a pause for the first time in 11 months, or longer than that when you really think about the fact that January doesn't even have a cash rate call happen. What does this mean for everyone from your perspective? Just to keep it super general.
Well, first of all, you're right about them breaking the cycle, because for a while we've been saying, oh my goodness, they're breaking their own record. Like the longest that they had increased cash rate was 7 or 8 times. And this is back in 2005, 2006. And so the fact that they got up to like 10 times, that's a record breaking by itself. And in a lot of ways, it's now they've broken that record. And, to be honest with you, the fact that they have made it stable this time around. The one thing that I do want to say, though, this is not a guarantee that it will continue being stable for the rest of the year or for next month or the month after. So the RBA is very much so led by data mindset and what the data is showing them. And one of the reasons why they did hold it stable was because our inflation rate is 6.8 back in February, so 6.8%, which is a decline from the 7.4 that we saw in January and lower than market expectations, which was 7.2%. So we've kind of had a couple of months of the inflation rate going down. And because it's been going down in that, trajectory 2 months in of going down, the household savings ratio have also dipped to below 5%, which is in itself is very concerning, Grace, because the 10-year average is about 5%. 5% is our normal household savings ratio. So the fact that it dipped down even lower than that means that we now have lower savings than pre-COVID times. So that is concerning. And because of these two main factors, and also the fact that other economies, so Canada and Japan, for example, they also held their cash rate decision in their last meetings, it does set a path for the stable call. However, this is not the final journey.
No.
This is, and I really just want to really put it out there, because the one thing that us as an economist know is that behavioral economics tell you that when things are stable, you have more of an opportunity or more likely to actually spend, because you kind of feel that, okay, the pinch is finished. We're entering a new cycle now. We're getting a little bit more stable. Our mortgage loan or our mortgage repayment is not going to change next month. So that means we might have a little bit more money to play with. And then if spending does go up again, then it means that the demand goes up, and that can actually result in inflation going up again. So it is very much so a wait and see. But at the same time, I think that's the main message, is that it's not over. This is not the final journey.
It is a great perspective to bring, Asti, because you think about the fact that even normal inflation is meant to be between 2 and 3%.
Exactly.
And we're still up far above 6%, which is a long way from where we want to be at this point in time. So it does make sense that we're not quite there yet. And there are so many, I guess, macro and micro influences that are being taken into consideration. Dr. Lowe's comments today at the National Press Club, we'll be running a few of them over the coming days, but even today, he said some interesting things that, there are so many things that we need to be taking into account, even the fact that on the mortgage books, how much people have in their offset accounts. That's that way to tell, how much money people are actually saving and the like. And I wouldn't want to be in their shoes, basically, at this point in time.
Oh, definitely not, because there's, like he said as well, there's so many things that has to be taken into account. Like our unemployment rate is still very low, and wage growth at the moment is still much higher than previous years. Yes, mortgage offset accounts is quite high in the sense that it grew phenomenally over COVID because people weren't spending, and so people were putting money into their mortgage offset account. Now, that has changed slightly over the past, 6 months or so since the cash rate hikes been happening, but it doesn't mean that that mortgage offset account has been completely eroded. And if you look at it from a worldwide perspective, a lot of other countries, our friends in the USA, in the UK, in New Zealand, they were all still increasing their cash rates. The European Union, they increased their cash rate by 50 basis points. Same with New Zealand. In their February decision, they increased it by 50 basis points. And so there are still a lot of other countries that, they do have a higher inflation rate than us, but they are still increasing their cash rate. So like I said, it's not the end of the journey yet.
Could I get you to put a final figure on where we could get with this rate? Obviously, we will not hold you to any predictions that you make today, because obviously there are so many things that need to be taken into consideration. But where do you think it could actually go to? Do you think you can put a figure on it?
Well, the last time that I met with the RBA and looked at their statement of monetary policy, back in February, they put the peak at just above 4%. So anywhere between that 4 to 4.1, 4.25 sort of range. That it's the graph that they've put out to inform this would be the peak. And then starting from there to hold it stable and start going back down and finishing at kind of like the high threes kind of thing. So it is a revised peak. Before, back in November, they said that the peak should be just under 4, whereas now they're saying that the peak will just be above 4. And then previously, they also said that we will end up by 2024, just under 3, so kind of like in the high 2s, whereas now they're saying that we'll land at about that 3.4, 3.5%.
Okay. So it is still being revised, but we're sort of getting to the top of the roller coaster before things start tipping back. Really, really great perspective and such a good way to frame this episode. We're going to come back just after the break and discuss what this actually means for the property market. Don't miss any of Dr. Diaswati Mardiasmo. See you on the other side.
This year might just be the right year to invest in property. But before you jump in, do you have a low-rate investment loan pre-approved? It might be the right time to invest, but the wrong loan could dent your prospects for achieving the maximum return. Are you armed with the best finance at the sharpest rate? Find out with Finny. Call us now on 1300 002 023 and find out what you could save. Or visit our website, finny.com.au to book an appointment.
Welcome back to this episode of Secrets of the Top 100 Agents. We are joined by Dr. Diaswati Mardiasmo, the chief economist over at PRD. And we love having Asti on the show because she just brings so much of a sense of what's actually going on from an economic perspective and what it means for property. You're completely entrenched in the property space, Asti. I'm very curious what you are seeing and the research you're doing at the moment. What is actually going on in the property market right now?
So the main thing that I would say that is happening in the property market right now is that more than ever, we are fragmented in the sense that there's markets within markets within markets. So if we're talking about the Brisbane market, for example, 5 or 6, 7 years ago, you can kind of get a sense of the Brisbane market as a whole. And that gives you a really, really good idea of what's happening for the whole of Brisbane. Whereas now there's a difference between the Brisbane house market and the Brisbane unit market. And now there's also a difference between certain pockets of Brisbane. For example, North Brisbane is still very much so being developed, and it's a much more affordable space than South Brisbane, who is still seeing that $800, $900, even $1 million sales. And then you have the blue chip suburbs. Interestingly enough, the blue chip suburbs, regardless whether you're in Brisbane, Sydney, or Melbourne, they're the first ones that actually got hit by the cash rate and showed a decline in prices. And that's because their price range is really high to begin with. So, you're talking about if you're in Brisbane, you're kind of like $2 million suburbs. If you're in Sydney and Melbourne, you're $3, $4, $5 million suburbs. Those blue chip suburbs they have been the ones that got hit first and where the declines have gone. And the reason being is that if you think about it, the mid-range, so say your 500K suburbs, there's a lot more people playing in that space because that's more affordable, right? Whereas if you're thinking about a suburb that is $3 or $4 million and you're faced with an increase in cash rate, trying to service a $2-3 million loan with a higher cash rate is much more daunting than trying to service a 500K loan in a higher cash rate environment.
Yeah.
And so the demand for those blue chip suburbs, they're the ones that, rolled back. Like it rolled straight back because of the thought of how much you could be paying more for your mortgage repayments. So, like I said, there's markets within markets within markets from a property stock type. From a locational perspective as well, we saw a decline or a steeper decline in Sydney and in Melbourne compared to in Brisbane and Adelaide and Perth, for example. Again, locational between the capital cities and the regional areas. So regional areas have actually proven to be really, really resilient when it comes to dealing with cash rate. We saw quite a big decline in prices in, say, Sydney, but the decline in price in Penrith and Tamworth and Newcastle, for example, are very minimal. And the same thing in Queensland. We saw a 5, sometimes 10% decline in prices in the Brisbane house market. But if you go to Mackay, you go to Toowoomba, you go to Hervey Bay, there's a decline, but it's like a 1 to 2%. So the regional markets have definitely proven to be more resilient when it comes to the cash rate hits or the cash rate shocks, so to speak. And the reason for that is the availability of a substitute. So if you go to a regional market, the amount of new houses that are coming into regional markets is definitely less than capital cities, the amount of units, the amount of lots. Whereas the population growth in regional areas have grown because of COVID, where many people are making the change to regional areas. In capital cities, you're getting 4,000-5,000 new houses if you're looking at Queensland, New South Wales and Victoria, and about 20,000, 30,000 new apartments in the capital cities. You don't get 20,000 new apartments in a place like, Tamworth, for example, right? So the availability of substitutes in regional areas is much more lower than in capital cities. And that's why the property markets in regional areas are more resilient because it or not, that's what you've got to deal with when it comes to supply. That's what's available to you. So like I said, we're definitely seeing that massive fragment right now between types of suburbs, like different types of suburbs, whether it's a more affordable suburb or a blue chip suburb, the stock type, whether it's house or unit, and then location as well between the different capital cities and then between capital city and regional area.
On those regional areas that you talked about, do you think that's a sustainable thing moving forward? Are we going to see supply continue to constrain, I guess, the availability of housing and keep those prices up? Or is there any fear that, in 12 or 18 months' time or even further afield, it's going to, come back down?
Well, Grace, I can tell you right now, we just did a Roaring Regions report where we looked at every single regional area across New South Wales, Victoria, Queensland, and Tasmania, and looking at the amount of residential dwellings, like standalone dwellings and units that are about to go to most of regional areas. It's still quite scarce.
Good to know.
Like Wagga Wagga, for example, 21 dwellings and 9 units planned for 2023.
Okay.
It's
we're at that level of scarcity.
Like Whit Sundays, a bit better, about 99 houses and dwellings, quite a lot of them, about 1,000 odd. But the one thing that I will say about regional areas is that there's a lot of lots being made. So hundreds of lots in Bendigo, hundreds of lots in, Tamworth or Whitsundays or Wagga, but not a lot of, incoming units that is ready to go or ready to sell, or standalone houses that are ready to sell. And of course, we know that with lots, it's great that they're available or that they're being created, but then there's also the building process until they can be sold. And we all know what's happening in the construction industry at the moment. Even though there has been some improvements in the construction industry, we're still hearing cases of builders, folding, right? Mm-hmm. And so even though those lots are coming, the actual supply of ready to sell, ready to live in houses and units in regional area will remain undersupplied and quite scarce for the next 18, 24 months.
I guess it even brings up the fact that people are moving to those areas probably now looking for jobs, and they're like, they need somewhere to rent while they're at it. And there's not enough supply for that either.
Well, see, we keep on talking about capital cities having like a very tight rental market and a very low vacancy rate. But I can tell you right now, in regional areas, it's even almost half in terms of vacancy rates. Like the vacancy rate in Brisbane is about 1.8 right now, but you go up to Whitsunday and it's like 0.6. Or, you go out to Hervey Bay or you go out to Mackay and it's 0.4. So there is still the demand for rentals are there. All of those key indicators that investors would look for, things like affordability, capital growth, higher rental yield, lower vacancy rates, all of those still exist in the regional areas. And if we combine that with, the very scarce supply that is currently in play, it will keep on creating a very, very attractive investment alternative for people.
All right. That's given me so much food for thought. We still have one more segment of this episode. Don't go away. We've got more from Asti on the other side.
Would you like the latest news and insights in HR, leadership and people management? HR Leader has you covered. Subscribe at hrleader.com.au.
Welcome back to this episode of the Smart Property Investment Show. We are joined by the Chief Economist of PRD, Dr. Diaswati Mardiasmo. And most of you who have been long-time listeners of the show will know Dr. Diaswati Mardiasmo is a friend to us. She comes on pretty regularly, gives us the goss, gives us the insight of what's going down in the property markets. But you've also probably known that she is a property investor herself. And that's why I love chatting with you, Asti, because not only do we get the perspective of what's actually going on, we know what's going on in your personal portfolio as well. And for anyone who hasn't listened back, which I highly encourage you to do so, how many properties are you looking after at the moment?
So the portfolio spans over, combined between myself and my partner, the portfolio spans between Queensland and New South Wales. So in Queensland, we still have our 3-bedroom unit in Indooroopilly, which, I love it because it's so near to the city. I will have to say that I've had a couple of times where I've had to look at what are the costs associated with that, because obviously for those of you who have units and townhouses as your investment properties, you know that body corporate can be a killer, and that body corporate has definitely been increasing. And especially for us in Queensland, we just got served our land valuation notice. And a lot of my properties have suddenly gone up in land value, which means that our Brisbane Council rates is also going to be going up in value in the next quarter. So we did have a townhouse in Bigara Waters that my partner decided to let go because it was no longer financially viable, combined then, and that's, in combination between the mortgage repayment increase plus the body corporate increase plus the council rate increase and all of the other insurance fees and things like that. The rental income it wasn't balancing out. And I think that's the one thing that a lot of investors talk about is that balancing, and many people don't know about, is that balancing of cost. For those of you who are listening and in Queensland, you'd be aware that the rental caps, has been talked about in the past week, 2 weeks, and also, that we can only increase by every 12 months kind of thing. And that income is really the one thing that we rely on as investors. That's the one income is the rental. And then you've got the other costs to balance out. So the bigger townhouse, unfortunately, was not financially viable anymore. So we let go of that. The more exciting part of the investment portfolio, though, Grace, is that in Edgeworth, in Lake Macquarie, we did do a subdivision of a big long block. And there's already a house, like a 3-bedroom, 1-bathroom house at the front, subdivided the land to create another granny flat behind that house, and then build another new 4-bedroom, 2.5 bathroom at the back block.
Wow.
So that one block gives us 3 rental incomes. And it's so exciting right now because we are like this close, like probably only like the last 2 steps before we get the keys to the back house after the project being delayed for about 3 or 4 months, actually getting that, that key. And if it does happen in the next 48 hours, then the next stage in my investment property journey is to make the trip down to Newcastle with a ute full of tools and bags of cement and all that kind of stuff, and then spend the whole of the Easter weekend concreting, landscaping, making a fence, getting the house ready for rent, hopefully after Easter or in the next couple of weeks. So
it's all happening.
It is all happening. I actually do get down and dirty, so to speak.
Good on you. Good on you.
Like the property in Edgeworth is the land is very much so like I always have to wear gumboots because it rains so much. And it's one of those land that can be a little bit hard with the weeds and all that kind of stuff. So I actually do get the gumboots out. I'm there using like all the machines to create like the fence post holes and, cleaning out. And I'm using the shovel to like put in all the new bark and mixing the cement to create concrete so that we can pour it in. And so that's the current
that's where you're at.
Project that is like right there to get this one last one done, because then that means that particular investment project or that investment property is done. It's signed, sealed, delivered. And then the next stage will be to look at other regional areas. That was one of our strategies, but I think I mentioned to you that we've kind of rerouted from the property investment strategy to a family strategy. So, it's all kind of happening in that space.
So basically, you want to get this done to then pivot and be able to look at what's going on family-wise. That's so exciting, Asti. Before I do let you continue on that path and what you're going to do there, one last question about the Edgeworth property. Will the plan be to hold on to all 3 of those properties there?
Yes. So the plan is to make that Edgeworth property, all 3 of them hold and create a cash cow. Out of it.
Yeah.
So both the Edgeworth property and the Indooroopilly property are cash cows in the sense that, with Indooroopilly, the fact that it's a 3-bedroom unit means that it is very highly sought after because a lot of units are 2 bedrooms. And so it does have that higher sort of like staying power in terms of rent. And, I remember when like the rental or the lease was up, we already had new renters signed on 3 or 4 weeks before the lease is up with the old renters. And that's because of the location and the fact that it's a 3-bedroom apartment. And so it widened the demographic pool as to who can access it. So because it's that style, that type of stock, and the one in Edgeworth are all 3 standalone houses. Yeah, that's like our kind of like our main portfolio cash cow.
Yeah, cool. And has it been expensive to do that Edgeworth project?
It has, both from a monetary and time perspective, because of the delays, whether it was because of COVID or because of a change in management with our builders, developers. I mean, I first started looking at the floor plans back in towards beginning of 2019. And that's the floor plans to subdivide. The plans to subdivide. And then after that, the floor plans for the granny flat. And then after that, the floor plans for the back house. Like it's been a journey since 2018. And now, in terms of buying the land and everything. And then 2019 in terms of actually acting on the property itself. So there has been quite a lot of that back and forward, and the fact that it's also a Queensland and New South Wales, like we live in Queensland, properties in New South Wales. It does mean that sometimes things have to go back and forth on email. People change. COVID happened. It has definitely been there. There were, I will say, even with this last one, so many frustrations on schedules and having to be flexible on like when things get done, costs. Yeah, it's definitely been a journey. But at the end of it, we get 3.
Yeah, and there's got to be some reassurance just seeing how much land values have gone up and property values have gone up in that Newcastle, Lake Macquarie area over that period of time.
Oh, for sure. And, at the end of the day, when it comes to investment, it really depends on what your strategy is, right? And something that I found in my journey as a property investor is that basically the best investment strategy is the best one that suits you at that particular time. It is not some investment guru's strategy. It is not your mom's, your best friends, or your partner's friend, or, your colleague or anyone else. It really is the best strategy is whatever is the best strategy for you in your family cycle and also your financial situation. Because, investments can be all sorts of different types. There's the short term where you want to purchase a property, flip it for 8 weeks and then sell it, or you want to create something long term, which is basically what we've done, and then use that as a rental income or a cash cow, so to speak, for your future and have that set up in the background. So, there's always that short-term and medium and long-term strategies as a generic sort of like investment speak. However, each investment strategy is so personalized because, as I've told you, I think the last time that we spoke back in December, I was still looking at other regional areas to have a look at to see what can we do next after Edgeworth. Whereas now we're at a stage where, no, that one, we're parking that one first because we are going to start looking into family options and rerouting our funds and rerouting our energies into IVF and actually looking into family options and what it is that we can do. P.S. I have permission from him to tell you that, by the way, but I'll let you know.
But thank you for sharing that because so many people, it's not a topic that many people talk about. But I feel like as well, and you might, I don't know if you feel the same or not, but your property journey to date is what has allowed you to be in a position where you think that this is the next best step for you.
It definitely has, because the thing about property investment is that many people think that once you're in property investment, that has to be your journey the whole way throughout. You're a property investor every single time. And, that's like the main thing. Whereas what we've done is that we've done all of this property investment journey to allow us to be able to do things. So to allow us to then plan for a family, for example, or to allow us to set up, some passive income for the future, So it's a little bit of that whole, what is the purpose of your investment thing? But also when it comes to property investment, the one thing that I've learned is the importance of flexibility. You can pivot and you can come back to it at a later date. It's so personalized that whenever someone says to me, oh, but that's not like what so-and-so said in their investment property podcast, or that's not like so-and-so's strategy, or, oh, my friend did this, or whatever it might be. The best strategy for your property investment is basically the best that is for you as an individual or as a couple, depending on your life cycle and your financial situation.
Everyone who is listening to this should be writing that down right now. You don't have to, focus on what other people have done or achieved or how they're going. Take your own journey, one step at a time. You never know where it's going to end up. Clearly, considering our last conversation that we had, and Asti, that is so exciting. Congratulations on making that decision, and best of luck. And I can't wait to hear what our next update is going to be from you, because I think there could be some pretty exciting stuff in the works.
Yeah, well, it's always what they say, right? If it doesn't scare you a little bit,
yeah,
it's not worth doing.
A great point to bring up. Asti, again, thank you so much for your time, for putting the property lens onto what's going on in the wider economy and sharing some of the areas that, I feel like even some of the regional stuff that you brought up, so important for people to take note of it and just be reassured by. There's still plenty of exciting things going on and so many exciting things to look forward to day that people should really be focusing on. So thank you again. We really, really appreciate it.
Thank you for having me.
To everyone who is listening along, we hope you have enjoyed this episode. Have a safe and happy Easter or a long weekend, whatever you're up to. Enjoy the weekend. If you do not celebrate Easter as well, 4 days off will be nice. If you don't get 4 days off, I hope you at least get some penalty rates alongside that. If you like this episode, like or review us on whatever platform that you do listen to your podcast on. If you have any questions, don't hesitate to reach out, editor@smartpropertyinvestment.com.au. Check us out on our website, subscribe if you haven't already, and look out for us on social media, Facebook, Twitter, and LinkedIn. Until next episode, stay safe and well wherever you're listening from. Bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Are you looking for a new challenge that combines your existing skills with the exciting world of mortgage broking? Well, listen up, because we've got the perfect opportunity for you. Introducing the Advisors New Broker Academy 2023, a free event designed for professionals just like you who want to learn how to become a trusted broker for their clients. Coming to Brisbane, Melbourne and Sydney in June, you'll learn from industry specialists and gain crucial industry insights and intelligence to become a go-to broker. You'll also have the opportunity to network with brokers at all levels and gain a competitive edge in the marketplace. Register now for free at newbrokeracademy.com.au and join the top brokers of tomorrow.